This video is brought to you by HalloCasa. Our tool transforms independent local real estate agents to global real estate agents. Create your own profile for free and get contacted by international investors. Sign up with the link in the description. Hello and welcome everyone to our 241st session of HalloCasa. My name is Michael and today I'm talking to Caleb Christopher, the founder and manager of Creative TC, a leading consultancy specializing in creative finance and real estate transactions. With a background in cybersecurity, risk management, and business consulting, Caleb brings a unique analytical mindset to real estate, helping investors structure complex deals with clarity, precision, and innovation. Through Creative TC, is really finding how investors approach creative financing, guiding them from pre-contract to closing with experts transaction management. Caleb, thank you so much for your time today. I'm really pumped to have you on the show. Why don't you introduce yourself to our audience?
It's an honor. Thank you for having me on. My goal is to basically make real estate safe, legal, and ethical because when I got into it, I experienced the darker side of it. I saw people just doing stuff just to get by, they're lying to sellers. I worked with wholesalers a lot. And so there's a lot of bad wholesalers. There's some good ones. But I saw the average Joe couldn't tell the difference between the two. And particularly in creative finance, which we'll get into in a minute, there's much more opportunity for people to do wrong to one another, intentionally and unintentionally. And so I set out on a mission to make those transactions safe, legal, and ethical, and I built a business around that.
Absolutely. I mean, however, like real estate hasn't been your main subject during your entire career. You also have like a very technical background. Tell us how everything started.
Yeah, I'm a nerd. I took my glasses off for the interview, but no, I have a bachelor's degree in cybersecurity. I was an IT director for several years. I like the cybersecurity aspect, but generally the progression is you learn IT, then you're eligible for cybersecurity. And so I self-studied, got a bachelor's degree from an online university where you can just study and test, and I got that done in 3 semesters, which was fantastic. And I was an IT and cybersecurity consultant for 5 or 6 years before I switched over to full-time real estate. Prior to that, I worked at a prison, so I had physical security, I've got cybersecurity, and in my long history, I don't know, can you call it long history? I'm 38 years old. I was a construction guy for residential real estate rehabs. So I had real estate, went into physical security, got to cybersecurity. I like the risk management concepts here, though. I really have always enjoyed that. And I always go deep on things and become the expert. I invented several products right before they came out. As I experienced the job at construction, I'm like, we should have this tool. That would help everybody a lot. And then I see it in stores like 6 months later, and like, always just behind the curve. But oh well.
Now tell us about Creative TC. You combine basically cybersecurity and real estate and also real security in order to basically create something new.
Yeah, it's about transferable skills there because I know what the inside of a house looks like, and I know what's behind the walls, and I've done rehabs, and I've been involved in flips, and so I've done my own flip as well. So I can do underwriting from a conservative perspective, but I've got the risk management as well. And I was the guy who was reading the policies at the prison for fun. I worked night shift, and you don't have reading materials there except policies and procedures. So guess what I read? Policies and procedures. And I tested out of English in college, and so grammar and composition, I was able to make corrections and submit as a low-level employee, submit those back to the senior management at the prison. So I learned a lot from the inside, and I connected with high-level people, and I saw the bigger picture. Because at the ground level, a policy is just a rule you have to follow. But at the high level, it's like, how do we communicate our intent? How do we document our intent and communicate that to the employees and to the public and to a court system? If something goes to court, what have we done to show what our intentions are? Did we follow the policies every single time? No, policies a lot of times are guidelines. And so it's the supervisor's prerogative to decide what's a guideline and what's a policy. But that was an interesting learning perspective for me as I came through the prison system. And that helped me get into cybersecurity, where you're never going to be secure. It's not a destination. Risk management is an ongoing thing, and it's a series of decisions over time, but you've got to achieve this outcome, and you have to take risks to do it. And as a business owner, you need outside perspective to see, what are my risks? How serious are they? What is the impact? And what other options do I have? And you just got to press forward. You can protect sometimes, you can defer, you can transfer risk to an insurance company, but when you understand the options, you can make informed decisions. And so when it comes to underwriting a transaction, should I buy this house, the single family house or this multifamily property? We have risk management in place. Have you looked at the local market? Or do you really trust the numbers from the sellers? Have you verified those things? People don't even think to ask these questions. And so I like helping those people get into their first, fifth, 10th, 20th deal where they're not seasoned pros yet. That's where me coming in as a consultant. I love being a consultant. I like the variety of it. And so I bring that risk management into real estate, particularly in creative finance. But the wholesale operation, the investor, that's where my heart has been for the last 3.5 years. And that's what Creative TC does. We help those people get those deals under contract, and we help them get to the finish line, but help everybody make informed decisions. And sometimes the best deal is the one you don't do. And so we help people see that. And sometimes they cancel a deal and they thank me for helping them dodge bad deal.
Allow me an ignorant question. You are creating for me conceptually a new term. You are not a valuer. You are not an underwriter yourself. You are not a bank. Where in the value chain do you come in? And what basically below your value hood or roof, what is included then? And who are you then basically including towards the end consumer?
I wish I had that question from you as a business coach when I was starting out. To have that much clarity of an answer early on would have been fantastic. So I'll tell the story. If you are trying to get a house under contract, you're trying to buy one from somebody, or somebody's trying to buy a house from you, I'm here as an independent third party. I'm not an attorney, so I don't want to come across the wrong way. I'm a consultant. I have lots of opinions. I've built a business doing things that are very, very infrequent. The sub-2 transaction where you take over somebody's mortgage. Relatively on the grand scale of what real estate is, that's not a common thing by numbers. And so how many real estate attorneys are ready to advise you on that who've been through thousands of those transactions? Not a lot. And if you can find one, then good for you. But a lot of times somebody's in need of a lot of learning and very little time. They don't have time to go buy a mentorship and go through the full courses. They've got less than 30 days to figure out, is this the right deal for me? Do I put my money on the line? And so my position in the value chain is that decision making right when you're either about to go under contract or you're already under contract. How do I decide how to move forward? What else do I need to bring in? What kind of insurance do I need to buy? What's the actual process? Because everybody makes it easy to understand on the internet how to get into a deal, how to get started. But once you're under contract, the title company does not provide guidance. That was my day of reckoning when I got a couple of deals under contract and we took them to the title company and they were not saying, here's your next step, here's your next step, here's your next step. They were like, nah, I'll put the money in escrow and we'll transfer the deed. That's all they do. And there was no guidance and handholding to ask questions. And so my value proposition is that we provide, it's practically a 30-day mentorship when you go under contract for particularly a creative finance deal. That's sub-2, seller finance, contract for deed, transferring into a trust and selling the beneficial interest. Like I might be going over people's heads, but these transactions get very, very complex. And sometimes you're like, which one should I do? I'm going to say, go with the one you understand. I can explain both of them to you. Whichever one you want to understand is the one that you'll be able to execute better.
Okay. There's not a lot which I'm understanding so far. What is sub-2? And it's me being European, so maybe that's also like my disadvantage. But what does sub-2 stand for? And also then maybe the other terms which are key when you have like normal client calls and you need to address certain topics. What are the main concepts you are dealing with?
Yeah, and you're right. For perspective, what is this much knowledge to other people is my entire world, right? That's where I've lived for the last 3.5 years. I have mastered this domain of creative finance. And so the label we place on this is creative finance. That's when you buy, I'm going to say real estate, when you buy real estate with non-bank financing. There are lots of different ways to do it. If I'm buying your property, whether it's a commercial property or a single family home, I can step into your company and buy ownership of your company, and your company keeps holding on to the real estate, and I progressively buy you out. That could be a seller finance method, right? Or if you have a loan, I could just step in, you transfer the deed to me. Now I own the property and I make your payments. That's the sub two. We're buying it subject to that loan. Now, there's a lot of complexities, and I don't want to get too far off track, but to keep this basic, I promise to make your payments. They're still your payments. It's still your loan. But I promise legally on a contract that I will make those payments for you.
So basically, we are talking peer-to-peer financing, and this is like what conveys or what describes the creative financing overall. So outside of the financial institutions, you are also having, on the one hand, maybe, is it not high net worth individuals, or is it maybe limited investors? You have maybe even your own
It's
limited
it's both ends.
partnership.
So if you're high net worth and you've got a very expensive property, it takes longer to move a very expensive property because you have a smaller pool of buyers. So what we have found is those people are more open to creative finance offers. Hey, let me give you a down payment. You be the bank. You charge me interest. I will pay you off over time. And if I don't pay you, as a bank, you can foreclose on me, right? I can get you your price. Your price is, $4.6 million for a property, and I'm talking US terms here. 4.6 million. There's not a lot of buyers for that property. But if I came in with $500,000 as a down payment, would you finance the rest to me? We can put a balloon payment in there where I have to go refinance it later. But my estimation of the market value of this property is 4.3. And that's what everybody else's estimation of the value is, 4.3. But I can give you your price if you give me terms, because I can't get a bank to finance your price. So let's wheel and deal. Let's make a deal. So with the wealthy, it's giving them their price and letting them become the bank and turning this asset into a second level investment where they're earning interest on it as well. That's the value proposition to the wealthy person in a high price property. On the low end, we have people who can't make their payments. Their credit score is getting damaged. And so I would offer, hey, I will catch up your payments. That helps your credit. I will make the payments. By the way, here's my credibility. Now, this is where you can get really unethical. You can trick unsuspecting people into giving you their house and letting you make their payments when you don't really have a commitment to make those payments long term. Yes, while it's convenient, you'll make them, but you're not committed for the long term. And so those people I want to keep out. I want to identify them and red flag them. So I go to the person and say, here's my credibility. I will make your payments. In fact, I got paid to buy a house once doing this in Colorado. I still own the house. The people had 2 house payments. They bought a new house already. They couldn't sell the other house. And they were on the verge of starting to miss payments, which would have ruined somebody's job. And they had to make both payments and they couldn't afford it anymore. And they said, Caleb, what can you do for us? And I said, it doesn't rent for, I would turn it into a rental, you guys, but it doesn't rent for what the house payment is. I don't know how you got into that situation, but I can't buy it. And that's why you can't sell it. I said, I know you're desperate though, so I will tell you what I'm willing to do. I don't really want this property, but I can help you. And the 10-year picture is really good. You have a low interest mortgage. That's really good in the long term. So if you paid me $200 a month, $200 a month for 2 years, I will turn this into a rental, and whether it's empty or it's got a tenant, I will make your payment. You can rest easy. You can sleep at night. This is handled. Caleb's got your back. Here's my credit score. Here's personal references and professional references. I intend to follow through on that. Okay, you guys? But that's all I can do for you. And they thought for a couple of days and they called me back and said, that's the best offer we've got. We'll do it. We like you. We trust you. You can take our house. So they signed the deed over to me and I took over making their payments. And I've had renters in about 60% of the time. It's a nice house in a not best neighborhood. And so sometimes it goes vacant for a couple of months. And guess who makes the payments? I do. And they rest easy. So that's the value proposition to somebody who's having a hard time on the lower end. They're either behind on payments or about to be. And having an open mortgage is pretty good for your credit. An open mortgage with payment history. So the age of an account is very important if we're talking credit score and credit history. And I provide that value to the low end of the spectrum. And at the high end of the spectrum, I provide, here's your price. Let's get it moving.
It sounds like a lot of administrative and operational work, but I know also that you have a cybersecurity background. You know the importance of creating processes and operational procedures and systems. How does it work on a practical level? do you create always a new entity? Do you run everything via your private bank accounts? How does it work?
My preference is I would create a company for each business model. And so a short-term rental, which I don't have any, that would be one LLC, and long-term rentals are a different LLC. Because from a risk management perspective, you have different risks over here than you have over here. And in the US, we use limited liability companies. And so each one is a legal entity. It has its own identity and tax numbers, income and expenses, et cetera. And so I might create a common property management company that does the financials for all of those, but I want to bury the risk or containerize the risk of a slip and fall accident or a lawsuit or something like that in one LLC. Generally, that's going to be one LLC per state per business model. So the US has 50 states. If I bought 4 houses that are long-term rentals in the state of Colorado, I would have them all in one LLC personally. Some people use a separate company for each property. That can get expensive, but if you want to limit the risk, you can do that. Then again, I have low equity properties. There's not a lot of equity there, so there's not much for an attorney to see and be like, ooh, there's cash in there that I can take. There's value. I can force them to sell and pay me off. There's not a lot there. If I had a lot of equity, I would either refinance my properties, pull the cash out and make it low equity again, or start partitioning out houses into separate entities. It's all about that active risk management.
In terms of accounting, you still then can subdivide those ones in order to stay on top of it, in order not to get mixed up, like just operationally. I'm just curious there.
For the small investor, one LLC, let's just say you have one LLC per property, you're going to have a separate bank account for each one. That is a lot of administrative overhead. A lot of stuff gets on auto pay, so it's not that bad once you have it going. But as you scale, that's not a scalable practice. And so building one LLC to be the property manager for all your others, or your finance company or something like that, everything passes up to the one and all the accounting is done on a per LLC basis. It's important, though, to do that the right way. Again, I'm not an attorney, but it's important to make sure that you're not mixing financials and treating it all like one, because then you've broken the containerization, and an attorney can attack that and say, these are all actually one. And so a lawsuit here actually attaches assets from over there to a judgment.
You just mentioned that 52 states, and I see on your website that you're like operating in most of them. Like there are a couple of white spots in Montana, North Dakota, South Dakota. I don't see anything right now. But your model works flawlessly also across the entire nation, or do you have to do a lot of adjustments regarding legal elements and maybe also financial exposure, certain mortgage topics? How does that work, and how have we been able to scale it so vastly?
It's when you're a consultant, it is a lot easier to work in multiple states. I run a remote company. We have 14 employees. I basically don't work in New York and New Jersey, because when you do a real estate closing in that state or those states, there's attorneys on both sides, and they don't like some dude in Kansas who has an opinion stepping in and telling them anything about what the transaction should be. And so I'm not going to swim upstream. I'm not going to fight uphill just to do deals in a state that doesn't like me. Otherwise, yeah, the buyer, the seller, the wholesaler, anybody involved in the transaction, even the title companies often value our input, because we've been there and we've done that. They've only done a dozen of these transactions at a title company. And I'm like, I've done hundreds in multiple states. I understand the disclosures. By the way, if you're in Montana, they have not regulated some of this stuff. Whereas I look at Texas, the state of Texas has very specific regulations on the sort of disclosures you have to give a seller when a seller is letting you take over their loan. That is a very risky transaction. And that's why I want to help people make informed decisions. Safe, legal, and ethical. That's the theme. And so when I look at Texas regulation, I'm like, let's design our paperwork to the highest standard in every regard. So the disclosures, they match or exceed Texas standards, which are the highest standards in the nation. And we use those nationwide. And so we cherry pick the most stringent regulation, the biggest, best version, and the most consumer protected version of disclosures from every different state, and we combine those into our master set of documents. And Colorado is where I'm opening a title company right now, so I know their laws even better than most others right now, and they have a Consumer Foreclosure Protection Act. And if you're buying a house from someone and you're taking over their loan payments, like a sub two. If you should, not if you do, but if you should reasonably know that they are 30 days or more behind on any payment related to the house, I don't care if it's utilities or the mortgage or anything in between. If you should know, then you must give them a 72-hour a notice that explains exactly what's happening and 72 hours to cancel without penalty. And if you don't do that, they can rescind and unwind the transaction for up to 3 years after you close on it. If you were one of my clients and you didn't know that, and I told you that, I could have saved you tens of thousands of dollars in risk where somebody actually unwinds a transaction that you invest extra money into. That's a risk that you never even knew existed. That's the value of the consultant. And so consulting scales pretty easily because we build knowledge and we apply it to your situation wherever you are.
What are the general questions when people book a consultancy call with you and consulting call with you? What do you think is like the biggest, let's say, lack of knowledge and maybe even awareness? Is it maybe also something very particular to each state? Or do you think like it's always this 80-20 rule of like top 5 questions, which you definitely see and you are always exposed to those and you guide them through those?
I'd say there's two categories of questions. There's either I know what creative finance is, but I don't know how it works. So that's question number one is, how does this work? I'm looking at a deal or I have a deal or I have a contract. I know what happens, but how does it happen? Who does what? What do I have to do? What are my legal and ethical responsibilities in this transaction? Because I know I can just go do the deal, but how do I do it right? So that's question number one. And question number two has to do with what's the best structure for this deal? Do I structure it as a seller finance? Do I do a formal promissory note and mortgage or bond? Or do we put the property into a real estate trust, like a land trust, and then I take ownership inside the land trust? Well, it depends on your tax situation. It depends on what you're trying to do with the property. What is your short and long-term plans? What is the seller's short and long-term plans? So now there's multiple parties that we have to bring in. So the two categories of questions are, I know what creative finance is, and I have a potential deal. I need to know how it works. Help me understand how this works for me. What does it look like for my day-to-day, my month-to-month, my year-to-year? And the other one is, what's the best structure given my circumstances? Basic and advanced.
Are there any clients where you say, okay, I can't help you? Like, is that also quite common that you say like, hey, listen, like, is this too late? If you had asked me like 6 months ago, yes, but you just did X, Y, Z, and this actually is quite quite difficult right now to really help you significantly.
Sometimes I have to direct somebody to an attorney because the court system is the only recourse for whatever they're dealing with. Usually that's not the case. Usually it's something where I'm looking at their situation and saying, this probably isn't the right deal for you. You should look at the cost of exiting as soon as possible. Here's why. Here are your options. I'm willing to help with document templates, etc. So if I could just go back one step, I really tend to work myself out of a job because people learn when they work with me, right? And my job is to make your next deal better and safer than the previous one and every one after that. And eventually, you don't need the how anymore. And eventually, you understand the structures that are available. And so the life cycle of a customer for me is somebody who buys their first creative finance property all the way up to maybe their 7th or 10th property. And it's a lot of hand-holding and training and helping them get this figured out and done the right way. And after closing support, we're here to answer questions. And we can't do stuff on your behalf, but we're here to help you, point you in the right direction so you can get the stuff done. And so that support is very helpful for people, and they graduate basically by working with us.
Do you see a certain trend that more and more people going for creative finance versus incumbent financial institutions? What has been the trend also since you started?
So I started the company in 2022. So it's 3.5 years old. And interest rates were really low in the US at the time, like less than 5% interest, which was pretty fantastic. So you have the government was giving out stimulus funds during COVID, and so everybody used that to buy. Like everybody sat on Zillow, scrolled their phones, and looking through what's available, made FHA loan offers, which are really low down payment, government-backed insured loans, and so Everybody's got their stimulus cash and they're like, this is a down payment on a house. And so we went crazy buying, and we had low interest mortgages, high risk buyers, low risk mortgages. That creates a lot of defaults, a lot of people going into default. And early on, that was great for sub two because, like I said, on the low end, I can just step in. I'll catch up your payments. You're $20,000 behind. That's nothing for me as an investor. Got you covered. I'll take over your payments. Here we go. So we had a lot of investors picking up these low interest mortgages from people who defaulted, which puts the mortgage back in good standing. However, over the next 2 to 3 years, there was still a lot of buying frenzy going on. And so if you bought your house at this price, it's worth this much in just a couple of years. It's insane. And I'm not saying that it's worth more so much as the dollar is worth less, right? So we understand that cycle. But to the homeowner, they've got a ton of equity and it went up quick, really quick. And so now you have this disparity where my loan balance is $200,000. My house is worth $375,000. I'm not just going to let you take over payments. Like, you've got to pay me my equity. And so it has slowed down a little bit on the sub two unless you've got more cash to give to the seller upfront. And I can pay you over time, but most people don't want $40 a month on a $75,000 equity stake. So we've seen a slowdown. We've seen higher down payments coming in from the sub two buyers, but a distressed seller is still a distressed seller. And so they're willing to move and do the deal at some point. So, but I see interest rates in the US are still in the 6, 7, 8% range. So people are holding on to their properties, not selling, because your monthly payment on the same house at a 3% mortgage is vastly different than a 6 or 7% mortgage. So your purchasing power went way down, and people are used to this standard of a house. They're not going to sell, cash in their equity, and buy this standard of a house. So we have a lot of stagnation right now. That's where things are at. I think as people grow their equity, they're going to look at a refinance because Americans are impatient. If we can get cash in our pocket and go buy a boat or a car or whatever, pay for college or a wedding, and it doesn't really change our house payment, fine by us. That's what we're going to do. And so I see a lot of refinances in the future if people can't move the properties and sell them.
To clarify, however, the mortgage rates are always fixed for 10 to 20 years, so it's not floating, correct?
30. We do have adjustable rate mortgages, some, but they're very unpopular after our market crash 07, 08.
So basically, now question here, playing devil's advocate, if nothing changed on my job, on my revenue, whatsoever, on my personal situation, and the payment plan is fixed, and I have my down payment, then I know exactly what for mortgage payment is due every month. Actually, my risk exposure is not that high as a person who got like a mortgage. What's happening? What is the situation of people then calling you and saying like, listen, I'm afraid to get defaulted. I might need to have like, I don't know, foreclosure, whatsoever. Please help me out. Is it divorce? Is it job loss? What are the normal situations then?
It's usually job loss, life circumstance change where the income doesn't come in anymore. Usually it's an underqualified person who got placed in a mortgage that they really didn't have the long-term stability to hold on to. Sometimes it's life circumstances that actually came in and messed somebody up, but usually we're giving money out to people who haven't proven themselves to be good money managers.
That's a good point, and you remind me of a conversation which I had with various brokers, especially Jacqueline Dancer from Miami. She pops in my head and says, don't stretch yourself so much. Just, like have, I don't know, a certain percentage on your bank account just for the situation of maybe not having income for 6 months, or the roof has to be repaired. She was talking about like hurricanes in Florida and stuff. Do you see like there a pattern of investors, of home buyers doing certain, let's say, mistakes, being too emotional in investing and less focused on the spreadsheet?
Yeah, absolutely. They're focused on what they can do, not what they should do. And now with creative finance, you have the opportunity to buy a house with no money out of pocket. That's pretty stinking cool. That's really cool to be able to do that. But that doesn't mean every potential sub two or seller finance deal justifies actually getting a zero out of pocket deal. For example, the one in Colorado that I bought, they gave me money every month to take over their payments. That's a zero out of pocket deal. That was pretty cool. However, I had reserves. So it is cool, and this is what I tell people. It's cool to do deals with $0 out of pocket. It is not cool to do deals with $0 in your pocket. You need cash reserves. Water heaters go out, roofs need replaced, stuff goes bad, you get leaks. You have to be able to service the property, especially if you are not the owner occupant. If you're buying it as an investor, and if you're promising to make John Smith's payment from now on, and you don't have cash reserves to withstand replacement of appliances or a vacancy in the property, shame on you. So yeah, that's that's the responsibility, the ethical piece.
Let me go back a little bit, and maybe I'm just cognitively too impaired here to have another follow-up question. The person paid you monthly, gave you a monthly payment in order for you to serve the mortgage towards the bank. Now, what you also then get out? Like, what is you get equity? You get like a share of the property. What's the deal on your side? What are you benefiting from? And maybe I missed that in the beginning, but it's all for me important to confirm that I get everything correct.
I probably misdelivered it then. I bought the house. They gave me the deed, and I promised to take over their mortgage payments. So for the life of that loan, I will make the payment, whether it has a renter in it or not. So I told them, I'll call them John and Judy. I said, John and Judy, I will make your payments. You don't have to worry about this anymore. I'm going to turn it into a rental property. This is my business model. It's what I do. It's normal. So I'll have renters in the property. We'll have insurance on the property. I will make your mortgage payments, and you give me the deed. I will own the property and make your payments. So that's what I get out of it. I get to take over their 3.625% interest mortgage, which had 28 years left on it. That's what I get out of it. And just like you said 5 minutes ago, that monthly payment is the same for 30 years. So yeah, this turns into major. Today's no cash flow. In fact, it was negative cash flow. It cost me every month to have the house. They made up the difference for $200 a month for 2 years. Okay. That's the deal that we worked. I didn't lose money to take over payments, but I also committed to make their payments. And when the house was vacant, it cost me money. That's fine. I understand that because the 5-year picture, the 10-year picture is I still have the same monthly payment, but rents have gone up, gone up, gone up, gone up. And now I've got $400, $500, $600, maybe $1,000 a month of cash flow out of that property over the next 10 years. And it's a 30-year loan with 28 years left. Cha-ching.
But why would they do that if they don't get anything in return and you just take over everything?
So they actually do get a few things. So I want a clean break, right? I want full control and ownership, but it's not like they don't get anything in return. There's several ways that they get paid. So if they're behind on payments and I catch up their payments, that's money that they owed that they would have had to pay. So unless the foreclosure fixes that. So there's money, it's not going into their pocket, but it's paid on their behalf. So I'm saving them from some back due payments. But a lot of times if they have equity, I'm paying them equity. Right? Whether it's $10,000, sometimes the property is worth what's owed. There's no value in the property, but I'm like, listen, I'll give you $4,000 for moving expenses so you can move. You can get an apartment on it with the first and last month rent. I'll front you cash to do that. Not front you. I'm not lending it to you. I will give you the cash so that you can move because you have a 4% interest mortgage. That's worth something to me. And I will overpay for the property today to get you to where you need to be because I do want to help people. There's a story here. So even if it's worth only what's owed, a lot of times they'll still get some cash in their pocket. Now, if they've got a lot of equity, they're doing it because they're getting payments. Let me say that again. If they've got a lot of equity, I might give them $10,000, $20,000, $30,000 up front, but then finance the remaining $40,000 or $50,000 over a 5 or 10-year period. Listen, I'll give you this much cash for today, and I'll make payments of $200 a month for the next 4 years, 6 years, whatever it is. So you'll get paid in full. You just can't have it all today. And that's what I can do for you. And so, yes, sometimes they do it and just let us take over to save their credit because a foreclosure is a very bad thing on your credit in the U.S. So sometimes just being saved from foreclosure is good enough for them. Other times, they've got equity and we pay out their equity.
You must have a very strong due diligence process. What for data and for consultants, I don't know, accountants, also even appraisers, do you take from your side in order to really verify that you are not getting something which surprises yourself afterwards?
It comes with experience. When you can evaluate a property remotely, but I bought a house sight unseen. I didn't go visit it, but what I did was I went on Google Maps, I looked at it from the street, and I told the homeowner, I said, let's start a video call. I got on Facebook Messenger video call, and I said, start at the street so I can see that I'm at the right house. It matches Google Maps, and walk me through the house. And I'll tell you what to take photos of, but I want to see it live as it is today. And I take a flashlight, and I want you to look at things, and I will make you look inside every closet. I want to walk around the foundation. So we had a 20-minute phone call where I did a video walkthrough. But you can also get boots on the ground to look at the property. From an investment standpoint, I don't think it's hard to estimate the value of a property. And so as long as it's pretty close to that number, really what I want in a sub 2 deal is that low interest mortgage. And that's what I tell people. Your low interest mortgage is an asset that I'm willing to pay for because I can't get those on my own.
What is, apart from that, the most attractive thing? Is it, you just mentioned interest rates, but is it also something else? I mean, for you, obviously, if you find something right now with someone supposed to be having a foreclosure and this property is on like 3% or 3.x% of interest rate, you're directly going to be like, okay, let's talk. Is that one of the main characteristics, or is there anything else you take normally into consideration when going further?
Excellent question. Low down payment. It's the low entry fee. For example, let's take easy numbers. If an investment loan wants a 20% down payment, if I'm going to buy a $500,000 house, that's $100,000 I have to have cash to close that deal, plus some closing costs on top. So I have to have $100,000 down payment plus, let's say, another $6,000 to $10,000 worth of additional expenses. That's a lot of cash. Meanwhile, if someone has a $500,000 house that they already made a down payment on, I can step into that for $20K out of pocket plus some closing costs and then make monthly payments on the rest. So I could buy multiple houses with the same pile of cash and probably at a lower interest rate than I can get for an investment loan. So it's attractive in that way. Sub 2 is not without risks. It is a complex transaction. I potentially have a crazy person attached to the deal who, if they call the bank, they can try to get my loan accelerated. So we didn't even dive into all of that. But when somebody's doing one of those deals in the US, there are a lot of factors to talk through. And sometimes you just don't want to go into business with a certain person.
What does happen more? The seller still being involved in, so acting as a partner and you jump in, or you take over? How does it work?
So we do not want to mix and match ownership. I don't want to take over 50% of the property or even 99% of the property. I want the seller out. Now, particularly with distressed sellers who are like facing foreclosure, they're behind on payments. I don't want to make a character judgment, but I'm telling you, you don't want to go into business with someone who has demonstrated, for whatever reason, their fault or not, you don't want to be in business or partnership with somebody who has demonstrated poor financial decisions or outcomes. It's just, so we want a clean break. I now own the property. If I default on payments, you can foreclose on me.
I understand. So basically, you want to mitigate all the risk on like spillover effects from a credit score, so that you don't have any affiliation with someone who potentially like has shown that they are not really creditworthy. Is it basically how?
It's more about managing the property and managing risk for me. It's not that I'm tying my credit score to their credit score, although I am saving their credit score by making payments on their loan. It's just somebody who makes bad decisions can make a bad decision and I'm stuck with them because the US treats it as a partnership anytime you're working with somebody. And so I'm equally responsible for bad decisions that they make. And if I want to sell or refinance the property, I have to have their signature. I want a clean break. I want to be full control, full ownership. I'm the business person. This is a business asset. You're a consumer. I don't trust you to manage a business asset.
Where do you see the trend? You just mentioned one very important element. You didn't say it, but you were referring to the money printing of the Fed. So house prices in terms of gold hasn't been increasing, but house prices in terms of fiat money has increased. Where do you see also then the trend going on a national US dollarized market level across the nation?
I don't like the dollar. I mean, I like being an American, having the dollar, because the world likes the dollar for the most part for now. So I get the benefit of having the dollar, but I don't like it. It's worth less every day in my bank account than it was the day before. And so I think parking money in real estate is a great place to do it, a great place to hold the money in assets that appreciate in value. Particularly, I like rental real estate because somebody else pays the mortgage down and the value continues to go up. So there's this just constant shift in my favor. Yes, we have dumb renters. Sometimes we have stuff go wrong. Electrical panels open up and wires. People try to touch wires, and you're like, "Stop! I'll send an electrician." We have floods. We have roof problems. But the long-term picture is that each house is its own basic retirement account for me. And as it pays down, the value's there. It's an illiquid savings account.
That makes total sense. And you can always adjust also the rent while your pension or your 401k is stagnant, basically.
Yeah. And so to answer the question, I don't think the dollar is going to do well. I think it's going to continue declining in value. I know it will. Everyone knows it will. That's the modus operandi of the U.S. government. So you have to find a place to store your dollars in a place that they won't devalue like that. Because cash in the bank is worth less every month.
Every second. Charlotte, thank you so much for your time. I know you are very busy and you're already running into the next meeting. I learned a lot. You gave me a very interesting overview on creative financing, how you help your clients, both on consultancy base, but also just contracting and really doing the hands-on work. You're very well connected across the US. You have an amazing portfolio of clients throughout the US, and you're operating in all 52 states, obviously preferably in the ones who are, let's say, more amicable towards your business model. You also had the patience to allow me to ask some follow-up questions in order for me to understand like more detailed what are we talking about. And basically, you're also helping financially distressed people, especially like those who are not at the best element and moment of their life, to really be like, one helping arm and say like, listen, let me help you out and let me go and, maybe also some emotional conversations here and guide you through and, allow you to vent. And I'm here for you. You also gave us a very interesting element regarding the trends and the future outlook from your side and where you think the market is heading, and definitely with your confidence saying, okay, we are much better off on rental properties and hard assets versus green paper. Is there anything else apart from that which you would like to mention to the audience, which we haven't touched upon?
As a business owner, I do like to share this. As a business owner, it is my pride and my honor to have 14 employees. And by the way, I hire out of South Africa. And so we've got a mix of United States and South African staff. And so I enjoy this team, the people that work with me, and I appreciate everything they do. One thing I realized was that it's my job as the founder to build a path of progression for their careers as well. And so I'm starting a title company right now as well. And my plan is to continue building businesses that add value within the real estate sector and giving my people opportunities to grow vertically and laterally. And so that is the pleasure of a business owner.
Perfect.
It's an honor.
That's amazing. Shalab, how can people reach out to you if they're interested to get in contact with you?
Find everything about me at calebchristopher.io. calebchristopher.io contains everything. I've got my Instagram, I've got Creative TC, DOSGuard, a title company. Like, I've got a lot of stuff going on. Find it all in one spot.
Perfect. I'll put those also into the show notes, and sending the best regards. And get contacted by international investors. Thank you so much. Sign up